We recently published our second half 2024 Global Outlook report, and our key takeaways are as follows. First, most investors are now comfortable with the global soft landing narrative. Upside economic data surprises out from the US in the first quarter has led to a pushback in Fed funds rate cut expectations from mid-year to later in the year. The more recent second quarter US data prints have been softening, but still support a soft landing story. Outside of the US, the picture is slightly more mixed. Growth prospects in the Eurozone look more upbeat in the first quarter, but France's snap elections have contributed to some near-term uncertainties because of a potential hung parliament. The UK's snap elections will also be of keen interest. Meanwhile, the Japanese economy has sputtered. Growth actually contracted 1.8% on an annualized basis due to weak personal consumption and business spending. But we do expect a rebound in the coming quarters. China's recovery remains uneven. The property sector slump has worsened, despite the mid-May announcements of greater policy support. The renminbi also remains under pressure amid weak market sentiments, even as we await the upcoming third plenum. For the rest of Asia, the picture remains one of general resilient economic health. While services demand has been supportive, especially with the recovery of visitor arrivals, the electronic scorecard has been more divergent, very much depending on whether they have benefited from the AI-related boom. Second, the disinflation trajectory remains intact, but the last-mile journey has been bumpy and very tricky to navigate. Hence the reticence of the US Federal Reserve to cut rates. As illustrated by the latest June dot plot, they have shaved down the number of cuts from 3 to just 1. But the scatter plot actually suggests that the balance is more finely calibrated. They had 4 members opting for no cuts, 7 members calling for 1 cut, and actually 8 members calling for 2 cuts. If you look at the European Central Bank, they cut rates in June, but recent upticks in inflation may mean that they will shy away from back-to-back cuts, and hence a pause is expected for the July meeting. The Bank of England's tone has evolved as well. The May meeting suggested that the committee's decision not to cut rates was finely balanced, even as they kept the policy rate unchanged at a 16-year high of 5.25%. Bank of England Governor Bailey said that it was good news that inflation is back to its 2% target for the first time in nearly 3 years. So markets are pricing in the possibility of an August cut. Meanwhile, the Swiss National Bank has already cut borrowing costs for a second straight meeting, and they actually see inflation subsiding to just 1% by 2026. Major central banks are also likely to step up on quantitative tightening to bring down their balance sheet sizes, which had ballooned since the pandemic. The standout really is the Bank of Japan, who may actually continue with monetary policy normalization in the coming months. In terms of risks, geopolitics remain front and center. Apart from the Russia-Ukraine and Israel-Hamas conflicts that have not been resolved, there are still various hotspots that market watchers are concerned about. The upcoming US election in November may be a potential wildcard, with significant implications for trade, tax, immigration, and other key policies that are at risk. The first US presidential debate saw Trump pulling ahead of Biden in the polls. Recall that Trump has threatened to levy 60% trade tariffs on China and 10% for the rest of the world. He also wants to renew his tax cuts and clamp down on immigration again. So what happens in the US does not necessarily stay in the US. In addition, there are worries about growing fragmentation, especially for key strategic sectors like electric vehicles. With the China Plus One diversification strategy taking on greater prominence, there are also concerns that if the incoming new US administration undertakes a tougher stance on China and targets what it sees as proxy conduits for Chinese exports, then the landscape could become even more complicated, to say the least. While risk appetite is likely to remain supportive, albeit sometimes choppy, in anticipation of imminent global interest rate cuts in the second half, there is still a need to be nimble and not to put too many eggs into one basket, especially if it is a mainstream consensus view. So watch for the curveballs and good luck.